Okay, I think we'll get started now. Can I formally say good morning to you all, and you're very welcome to today's seminar. I am John Sanford, the chair of the Council of the Central Finance Board and the chair of the Board of Epworth Investment Management, and I'm delighted to welcome you to today's mini conference. It's great to see some familiar faces, but also some new faces to these conferences. As most of you know, the Central Finance Board is responsible for investing Methodist Church assets, and Epworth Investment Management Limited is responsible for investing other charity assets. I'll introduce the team who are going to present to you in a few minutes, but just to acknowledge that with us today is the Chief Executive of the CFB, David Palmer.
Morning.
Morning, David. Besides myself on the council, Anne Ellis is with us today as a council member. And we do have a couple of board members present with us today, Martin Rees and David Haslam. Welcome to you all. And in addition to David Palmer, Stephen Beer, our Chief Investment Officer, is also with us today. Welcome again, Stephen. In the last few years, we've held a series of conferences on ethics and investment across the country in November. But with the continuing pandemic, we felt that it would not be appropriate to bring so many of our colleagues, customers and friends into the same place. And probably it's illegal as well. So instead this year, we're going to try something new. We are having 3 short online events today, next Wednesday at 11:15 to accommodate the 2-minute silence, then on Wednesday the 18th at 11 AM. Each conference will look at different features of ethics and investment, and also give everyone the chance to meet more of the team, and indeed see them present in their own homes. And I'm delighted that you've joined us for today's conference, which looks at the core of ethical investment. This is something around which the CFB and Epworth have been built, and we have been doing for 5 decades. 2 of our colleagues, Matt and Christoph, are going to try and answer the question, does ethical investment work? I sincerely hope the answer is yes. But before they do that, I would like to introduce them to you. Matt is one of the fund managers who manage the UK Equity, Global Equity and Climate Stewardship funds. He holds the CFA Charter, and outside of work is a trustee of his local church and plays the drums in the band. Christoph is our head of investment management and known well to many of you. He looks after our customers and their portfolios. Outside of work, he's a Methodist local preacher and a keen runner and orienteer. With today's conference, there will be time for Q&A at the end, and I will make sure we finish comfortably before 12. If you have any questions as you go along, can you type them into the chat function, and then I will read them out and get our team to answer them. Can I also suggest that you turn your Zoom to speaker view so that you can see the speaker rather than a very small version of the speaker on gallery view. And with that, I'll hand over to Christoph. Christoph.
Thank you, John. As John said, I'm a keen orienteer, and in some orienteering races, you'd get penalties for going over your allotted time. So I'll be making sure we don't do that today. And you can also get disqualified if you go out of bounds. And the investment equivalent of that might be not showing your risk warning. So in the interests of making sure we comply with all the regulations, your attention is drawn to the following risk warning. And page 2. Now, to the matter at hand. It's such a simple question, isn't it? Does ethical investment work? It has many different aspects to it, and how we go about answering it depends a lot on what we think ethical investment actually is. There are a lot of different views out there. I thought I might start with a little history. In the early history of ethical investment, a great defining issue was this. Back in the 1970s and 80s, there was a great deal of campaigning and unease about apartheid South Africa and what investors should do with companies in their portfolios which invested in South Africa. Should they cease investing in them? And if so, what kind of test should they use? Or should they engage with the management of the companies to try to get them to leave South Africa? Back in the 1970s, we at the CFB proposed the first ever ethical motion at a corporate AGM when we asked Midland Bank to stop lending to the South African government. And when I looked through the archives while preparing this talk, I came across campaigning leaflets like these. They urged church and charity investors to sell their shares in Shell as a result of its operations in South Africa. Now, thankfully, the apartheid regime in South Africa is no more. But as ethical investors, we're back in the situation where there's one great defining issue. And 40 and 50 years on, we're all asking ourselves similar questions. Should we cease investing in companies involved in the climate emergency? Should we engage with their management teams to try and reform them? Should we only invest in companies which are part of the solution to the climate emergency? And indeed, some things definitely don't change. Shell remains a controversial company, but now for very different reasons. These three questions have been there throughout the history of ethical investment and represent the three main strands of ethical investment. To use the jargon of our trade, these are, firstly, exclusions. This is where an investor decides not to invest in a company if they derive more than a set percentage, usually 10%, from particular industries or activities. Apartheid South Africa was an early example, though others include alcohol, armaments, gambling, pornography, or tobacco. Secondly, engagement. Trying to change the behaviour of companies where the concern isn't about what they do, but how they do it. Issues which investors often discuss here include the climate emergency and the transition to a low carbon future, pollution, human rights, working conditions, executive pay, the living wage, tax justice. The list is almost endless. And thirdly, positive investing. Investing deliberately only in companies which represent a solution to a particular issue. Some mainstream examples might include renewable energy as a solution to the climate emergency, though others might feature microcredit lending in developing countries or financing tree planting projects. So the question we have before us is, does it work? This world of not investing in some companies, asking others to change their behaviour, or investing only in a narrow subset. But as we answer that question, we need to remember to answer it on two levels. Not only does the approach of exclusions eliminate our exposure to certain industries, does engagement actually change anything? But also, these are still investments. When we make them, we're still expecting to generate returns to finance the work of the charities we represent. For a long time, as ethical investors, we faced a great myth. There had to be a cost from this approach. You could do good, or you could do well. But could you really do both? And before we go on to discuss investment performance and income, let's start with engagement. Does it really work? Over to Matt.
Thank you, Christoph, and good morning, everybody. I hope you're all safe and well. This is a great question. Does engagement work? And one that can be difficult to answer definitively. If I may start at the outset with our own view, which John briefly mentioned in his introduction, we are very much believers that engagement does work in many cases. And this is why we dedicate reasonably significant resources to writing to companies that we invest in and meeting with those companies and to voting at shareholder meetings of those companies. Where a company is smaller and we might be a relatively larger shareholder, we can tend to access management more directly in order to influence positive change ourselves. But in the case where we're seeking to engage with much larger multinational companies and our individual influence might be that much smaller, we initiate and support investor initiatives that unite many voices for a more powerful impact around ethical issues. So if I may start by providing an example of what I would like to talk about regarding engagement, and I hope you can all see the slide clearly. This is, we've been looking for a long time of ways to engage on the important issue of tax justice. We believe that all companies should pay the right amount of tax transparently, in the right location, and at the right time. And we believe tax justice is a growing issue of much importance to the church and to wider society. So with that in mind, you may have come across the Fair Tax Mark. This is an independent accreditation aimed at UK companies, allowing them to receive a voluntary assessment of their tax policy and practices in a similar way to the National Living Wage Foundation employer accreditation that asks companies to commit to paying all employees and subcontractors a rate that is deemed sufficient to live on. We spoke to a company in which we invest earlier this year. That company is called MJ Gleeson, and we spoke to them about the Fair Tax Mark. Gleeson is a UK house builder focused principally on building affordable homes in the north of England. It is a company with which we have a good relationship. We've been shareholders for a long time in this company, and we know it is truly committed to ensuring that it has the most positive societal impact that it can. So we felt this was a good place to start. The company had not heard of the Fair Tax Mark before we raised the accreditation with them. And I'm pleased to say, as a direct result of our engagement, the company has improved its tax policy and recently achieved the accreditation. This makes it the first UK house builder to achieve the Fair Tax Mark. We regard this as clear evidence that of the success that engagement can bring. We now use Gleeson as an example, not only to other UK house builders that we invest in, but also to a broader set of UK companies. And we have now written to several other of our UK investments, asking them about the Fair Tax Mark, and we are able to cite Gleeson and others as an example. So that is hopefully an example of how we can engage on an individual level and on a small level. But I want to talk about also how engagement might work on a collaborative basis with larger businesses and ask the question, are these as successful? Can we engage successfully with large businesses? Well, for many years, the Church Investors Group, of which we are a member, has engaged with many businesses, asking them to improve disclosure around climate-related risks and exposures. As part of this, a few years ago, many years ago, in fact, 53 FTSE 350 companies were earmarked by the Church Investors Group as not matching the standards achieved by the majority of the companies within the FTSE 350 index. They were encouraged to report data required by the Carbon Disclosure Project and to seek to improve their scores. And then more recently, a study has been done to assess the success of these engagements. The results found that nearly 30 of the original 53 companies, of the constituents companies, had improved their disclosures score, so that's more than half. And management of greenhouse gas emissions had also improved, as well as just the disclosure. So academics at the University of Edinburgh have independently examined the effectiveness of this project, and they concluded with a 95% confidence rate that the improvements seen by these companies would not have happened without CIG's engagement. So having said that, I've presented some positive examples of where engagement has made a difference, but it would be wrong to say that all engagements we conduct are necessarily as successful as this, which brings me on to the topic of the climate emergency. You know, sometimes we engage with companies and they might make improvements, but they might not satisfy all of the original objectives of the set out at the start of the engagement. And other times companies might simply ignore or not respond altogether. So with the example of the climate emergency, we can look at the response of the oil and gas companies across the industry and see and judge the relative effectiveness that engagement has had over the last decade or so in particular. So we know investor coalitions have engaged heavily with each of the oil and gas majors in both Europe and North America, and essentially seeking to see these companies accept and align with the objectives of the Paris Agreement. In this country, of course, the main focus has been on BP and Shell. Not that long ago, these companies repeatedly denied that emissions from their operations and the use of their products contributed to the climate emergency. Now, not only do these companies acknowledge this as a serious risk, but they are publishing plans and scenarios that see a significant fall in oil demand and targets and commitments to adjust their strategies accordingly. In the not too distant past, this might have seemed nigh on impossible. And we would argue that this change in approach and this change in stance by BP and Shell and other European oil and gas companies is in no small part due to the significant shareholder pressure and engagement that has been exerted by ethical investors such as ourselves over the last few years. However, of course, there is plenty more work to do before we can conclude that this engagement has been a universal success. And you'll be aware that earlier this year, we, the Central Finance Board and Epworth, took the decision to divest from BP on climate change grounds. But let's also look at other companies in the oil and gas sector. And I briefly want to mention the example of ExxonMobil, which I'm sure a company you've come across. It continues to largely defy similar engagements from ethical investors. This company is actually boosting planned oil production, as the company claims that society will need fossil fuels for many years to come. Exxon has only recently even accepted the validity of climate science, but it simply does not believe in the transition away from fossil fuels and oil in particular. Many investors, including church groups, have tried for many years as shareholders to engage with Exxon as part owners of the business. But evidence of significant improvement in the ethical approach of Exxon as a result of this activity is, let's say, difficult to identify to date. This perhaps shows that not all engagements are successful, and then brings us on to the question of when is the appropriate time to consider excluding such companies. At this point, I hope Christoph can help us out here, so I shall hand back to him.
Thank you, Matt. That was really helpful. The next aspect of ethical investment that we're going to look at is indeed exclusions. Do they really work? Can we really eliminate exposure to an activity that we don't want to finance or profit from? That could be a relatively simple, clear-cut economic activity, such as tobacco. Apparently, over 7 million people die from smoking each year. Or it could be a much more complex issue, like apartheid in the 1970s or 80s, and the climate emergency today. Could we stop funding the climate emergency? It sounds such an attractive, simple proposition. Let's start by thinking about how investment managers solve this problem. Often we use the word screening. There are various information providers which provide information about companies, where they operate and whether they get significant revenues or profits from certain activities. To use the first of our examples, tobacco, it's easy for us to find out that two of the larger UK companies, British American Tobacco and Imperial Brands, derive almost all of their revenues and profits from tobacco. But what about judging conglomerates where a portion of revenue comes from tobacco manufacture? Where should we draw the line? Is 50% too much? Is it 20%? Is it 10%? 1%? Or even anything above zero? Often, investors have drawn the line at 10%, though this doesn't have to be the case. And often we speak to campaigners within charities or churches who would like the line to be drawn much lower and to drive down exposure to zero. So let's take tobacco as an example. Would zero exposure to tobacco mean excluding any other companies apart from just big tobacco? The answer is yes, and some large companies. The main ones would be the supermarkets. I took this screenshot yesterday of a supermarket website. They're all retailers of tobacco, as well as alcohol and gambling products. Their tobacco sales might be large in absolute terms, but they're relatively small in proportion. If we had a 10% limit, they'd be investable. But if we had a 0% limit, they wouldn't. We can talk about other issues in a similar manner and gradually whittle down our list of possible investments until none were left. All of us as individuals have our imperfections, as do the charities we represent, and companies are no different. For some of them, it might be about some of the activities they're involved in. For others, it might be about how they go about those activities. The perfectly ethical investment doesn't exist. But most of us feel that doesn't mean we shouldn't try and limit our exposure to activities we don't want to finance. We might be looking at a sea of grey in terms of corporate behaviour, rather than extremes of black and white, but we still draw the line between acceptable and unacceptable. That 10% threshold that I spoke of has emerged as a practical solution to an otherwise almost impossible problem. But there are times where we might want to set the threshold at other levels. It's a hard and difficult decision, on one where we at the CFB in Epworth are blessed to have an ethics advisory committee to guide us as we explore these issues. Now, so far I've talked about tobacco. It's a relatively easy issue in the world of ethical investment. But much harder is the climate emergency. This isn't the place to have a debate about the merits of investing or not in fossil fuels. There are plenty of other fora where that takes place. but it does raise some very difficult issues to investors who decide they don't want to finance global warming. What do they divest from? Fossil fuel producers or fossil fuel users? Do they divest from the worst or all? Do they think about the direction of travel or just where a company is now? It isn't just an academic question. Last year, some of our investors decided they no longer wanted to invest in fossil fuel producers, the likes of BP and Shell. We explored setting up a new fund in a forum with them. And one of the questions we discussed was this: would it make sense to sell your shares in BP on climate emergency grounds and reinvest the proceeds in the owner of British Airways? And if not, then where should we draw the line? There are plenty of very carbon-intensive industries, such as cement or steel. What should we think about these? While it sounds complex and we can't eliminate our exposure to the climate emergency, or indeed other activities we prefer not to finance, we can limit that exposure dramatically, and the information tools exist for us to do so. So having thought a bit about exclusions and whether these work, Matt's going to reflect on performance. Is there a cost to having an ethical approach or not?
Thanks again, Christoph. So hopefully I can give you a couple of thoughts on about the potential performance cost of investing ethically and what we can do to try and mitigate that impact. It's a question for many years as to whether ethical investors should have to accept inferior returns in order to screen out sin stocks. Often the debate can centre upon the performance of a given index and comparing that to that same index performance, but where those sin stocks are removed. Let's take the example of the FTSE All Share, and if we adjust it by simply stripping out stocks such as tobacco, alcohol, gambling stocks, let's call that the traditionally adjusted index, simply the main index minus the exclusions. The problem that we have found with this approach in the past has been that many of the stocks considered unethical through the recent history are inherently defensive by nature. Christoph's talked at length about tobacco stocks, and that's such a big factor for UK investors simply because British American Tobacco and Imperial Brands are such large companies and make up such a big proportion of the FTSE All Share Index. So excluding them will have a more material impact than the smaller exclusions in other sectors. But all of these, or many of these exclusions have a similar theme. They provide addictive products and services, whether it's tobacco, gambling, or alcohol, and others. And this has tended to mean that these sorts of companies and their more defensive characteristics might outperform in a more economically turbulent environment. Therefore, if these companies are excluded on ethical grounds, the characteristics of the index that remains needs to be considered. And if it's not, then this can have a negative impact on investment performance. So how can we mitigate that impact? How can we reduce or completely negate the possible impact of our ethical exclusions? Well, at the Central Finance Board and Epworth, we have some time ago developed a methodology that seeks to identify companies with similar characteristics that are ethically acceptable to those companies that we have excluded. And these stocks can be used to rebalance and ensure that the cyclicality of the resulting portfolio is not significantly different from the unadjusted index. So in effect, we are sufficiently compensating for the exclusion of less cyclical companies by applying a greater importance to other less cyclical sectors, such as consumer staples companies and healthcare businesses. So we would call this the proprietary method. But to try and bring it to life a little bit, I've got a chart I hope to be able to share with you to try and illustrate what the impact of those two different methodologies has been. So this slide is, this chart is based on data produced by Portfolio Evaluation for the CFB and Epworth. And it hopefully illustrates the impact of how excluding on ethical grounds has impacted returns over the last 12 years. So this chart goes back to September 2008. You can observe that the returns of each of these methods has fluctuated relative to the FTSE All-Share. So both of these indices are relative to the FTSE All-Share. So a flat line would imply that returns exactly match those returns of the FTSE All-Share in any given period. One can see that during the period of the Great Recession, between roughly 2008 and 2012, the impact of excluding companies was negative compared to the main market. However, since 2013, the impact of excluding companies on ethical grounds in the UK has not had such an observable detrimental effect on returns. And in recent years, we've actually seen the most ethically adjusted indices outperform the main market. The biggest single reason for this historic fluctuation is probably the performance of tobacco stocks, which given their size in the FTSE All-Share. Their defensiveness essentially helped them outperform during the financial crisis. They saw a smaller drop in business than many other more cyclical sectors. But more recently, they have given a lot of that performance back. The other point to note is that the returns generated from the two methodologies I've outlined are actually quite different. So the bottom line is the basic traditional approach I outlined first, which is simply the performance of the FTSE All-Share minus the ethically excluded stocks. The line above that is our proprietary method, which attempts to reweight for those more defensive stocks to improve the cyclical balance and make it more reflective of the main unadjusted index. And you can see that that proprietary method has done a much better job of tracking more closely to the performance of the FTSE All-Share. There are years where you have to accept some volatility, as is inherent in investments. But over the long term, we think we've demonstrated that an ethical investor does not have to accept long-term inferior returns. We think that is not the case. Yes, so let's moving on from that. You don't just have to take my word for it and our word for it. The view that investing ethically should have negligible effect on returns over the long term is supported by other studies. There is one by Newton Investment Management, which considered stocks across the globe from the period 2004 to 2015. This study concluded that there was no significant impact from screening fossil fuel companies on portfolio returns. So whether we've looked at the UK market, where the main impact historically has been defensive tobacco stocks, they concluded that in the case of fossil fuel companies, which is now much, the fossil fuel divestment has very much come to the fore of the debate, their conclusion was the impact of excluding those should not have a detrimental impact on returns. There have been other studies out there by firms, including Hermes Investment Management, that have also shown that engaging with companies, as I talked about earlier, in investment portfolios on governance and environmental and social issues can increase investment returns. The argument is that this is a result of focusing companies' boards' minds on longer-term issues, longer-term ethical issues and sustainability issues, rather than just short-term financial targets. So I hope that's been clear. But with that, I'll hand back to Christoph, who can briefly touch on some other aspects and considerations that ethical investors need to consider. Christoph.
Thank you, Matt. Now, we should be aware that Matt and I are investment managers. And one of the criticisms of investment managers is that we focus too much on total returns when we compare things. All the data Matt presented just now were total returns. They include both the capital and income in one easy calculation to produce a simple, easy to understand data point. But for many investors, there are other factors that matter as well. and the two that are often discussed are income and risk. On this slide, the 15 largest dividend payers in the UK last year. They're largely well-known companies. Many of them are oil companies, tobacco mine companies, miners, or distillers. And if we applied a screen for all these issues to that list, this is what it would look like. It's quite stark, but there are things that as investment managers we can do. Earlier this year, we launched a new fund that didn't invest in oil and gas in response to demand from our customers. When we discussed fund design with them, they told us that income was their key concern, knowing just how important dividends from Shell and BP had been to their historical income. And it's pleasing to report that that new fund, the Epworth Climate Stewardship Fund, we've launched isn't expected to have a lower income than the existing fund in the UK. Yes, it is an issue, but it is an issue which we can address and which we have addressed. Now, before we go on to questions, Matt will just summarise the key points from today.
Thanks again, Christoph. Yes, just very briefly, let me summarise the key points and issues that we have presented. And I can hopefully share a slide to help us summarise this. First of all, we have defined 3 key strategies that an ethical investor can use: engagement, exclusion, and positive investment. We've described and attempted to provide examples of each of these and discuss the relative effectiveness of each in various cases. I've also argued that ethical investors should not necessarily expect to generate inferior returns over the long term relative to an unadjusted universe, but should be cognizant of the approach that they take to ethically adjusting their portfolios. Christoph has just now warned that ethical investors also need to consider the impact they might see to their levels of income, and has briefly discussed ways of mitigating this, including the Climate Stewardship Fund that we have launched this year. But we should make it clear that we have simply scratched the surface within the time available on many of these topics that we've discussed. But I hope you found the presentation clear and informative. I'll briefly put up our contact details if you would like to ask us questions subsequently, but I hope we've got a couple of minutes, so I hope we can take a few questions. So I'll hand back to John on that basis, but thank you.
Thank you very much. Thank you very much, Matt and Christoph, for that really helpful and informative presentation. We haven't received any questions in the chat room. If anybody has got any burning questions, perhaps they could wave or signal, and I'll pick them up. I see Rob Jackson is waving. Do you want to unmute yourself and ask your question, Rob?
That's it. Can you all hear me?
Yep, we can hear you, Rob.
Thank you very much. Most interesting talk, thank you. I've just got a question about this fair tax mark and MJ Gleeson. I looked them up at Companies House, and there's 4 companies which are within the group. I haven't had a chance to look at it in detail, but when you say that you examine, or their tax ethics are examined, what about the director's remuneration package? Is that also looked at when you're looking at this, where they get this fair tax mark tick, or whatever you want to call it, accreditation?
Shall I handle that question, John?
Yeah, thank you, Matt.
So thanks for the question. Just to, so with MJ Gleeson, topics like, I mean, the fair tax mark in itself is its own accreditation. It's an independent organisation. It's not something we've created. So that their website is available there with the methodology, the full methodology listed as to how companies can achieve the accreditation. And we think it's a fairly rigorous process they need to go through to achieve the accreditation. With things like remuneration of executives and things like that, these are other areas that we've engaged with the company on in the past, and other companies. We will vote accordingly at AGMs. I was merely talking specifically about this example of tax justice and trying to, we engage positively and look for ethically positive companies. A lot of the discussion around tax justice focuses on your big multinationals and their various schemes. We wanted to provide some degree of certainty that there are companies out there that seek to do good in more than just providing their products. And I've provided MJ Gleeson as an example of this in this case. So I hope that answered the question.
Thank you.
Could I just add something to Matt's comments? We talked a bit about engagement, and one of the aspects of engagement is voting. We always vote our shares in the companies we hold, and one of the big issues for voting is around executive remuneration, as you've touched on. We've talked about some of the successes, and Matt also talked about some of the frustrations of engagement and being an ethical investor. And I think one of the frustrations that I would have over the last decade is around executive remuneration. We've consistently voted against about 2/3 of executive remuneration reports at AGMs, and that figure hasn't really changed in the last decade. I would love to be able to tell you that we voted in favour of them all last year because they were all reasonable and proportionate. It is an issue. It's an issue we discuss with companies, but it's a slightly frustrating issue where perhaps we haven't made as much progress as we'd like in recent years.
Thank you.
I saw that Chris Butler and Francois Bloom put their hands up. Chris has very helpfully put his question into the chat room, so I'll ask that now. It says the composition of the UK market seems unhelpful, particularly for ethical investors. Does this point to a global approach to achieve diversification as well as access to a wider range of positive opportunities? I suspect, Christoph, you're the one to handle that one.
Okay, Matt's also one of the managers of the Global Equity Fund, so he might want to jump in.
Sorry, yeah. Sorry.
No, I'll start. Yes, it does, is the short answer. So we have both a global fund and a UK fund. The global fund has much more diversification internationally, as you'd imagine. And the UK fund is quite heavy in both tobacco and oil companies. And so when we launched our new climate stewardship fund, if you like, it had a UK focus because the problem was predominantly in the UK rather than in the global market. So the global equity fund is there. It has a much more diversified universe. And in fact, if you look at global markets, those two issues aren't so prevalent. I don't know if Matt wants to say any more about that global equity fund.
Yeah, no, thank you, Christoph. Yeah, so I work on the global equity fund. I guess that's right. If you look at the global equity market overall, there's much greater weight to sort of technology companies, industrial companies, which tend to be less, have fewer ethical problems or have done to date, though there are, of course, issues with those companies as well. I guess the main issue globally, investing globally for an ethical investor versus the UK, is yield. In this country, and Christoph has highlighted some really big dividend payers in his slide. And in the UK, we're used to quite high dividend yields from quite a lot of the major companies. That's simply not the case in all global equity markets, particularly where there is a technology focus, fast-growing companies. They don't view dividends as such an important feature. They might engage more in share buybacks as well. So yield is one of the greater challenges of investing globally versus in the UK, I would say. So there are a mixture of different challenges for each market, and it's our job as investment managers to navigate those challenges. But I hope that provides a bit more of the picture for you.
Okay, I said I'd come to Francois next. We've also got a question from David Haslam in the chat room, which I'll take after Francois's question. Francois.
Yes, thank you to give me the right to say something. I am sorry, I am the only French national to talk with you, and I hope you will understand me. I just would like to make one great comment regarding one company you mentioned, or two companies you mentioned in the tobacco industry. I am not a smoker. I have never been a smoker. I dislike people smoking. But I have been an employee of a filter cigarette producing company. It is in contradiction. But I think we should be very balanced in the way we approach the problem of ethics, because if we want to withdraw from the tobacco industry, that's because of the health impact and the consequences for our social security systems. But in that case, we should be very consistent. We should withdraw from investing in Coca-Cola, in Pepsi-Cola, in Schweppes as well, because soft drinks are very bad for the health of the people as well. It's probably softer than tobacco, but it is a fact and it is a case. We should withdraw as well from chocolate makers, because chocolate is full of fat and it is bad for the health and the heart of any of us. And therefore, in the way we should approach the issue should be well thought, not to disturb fundamentally and at once and suddenly the industry. You mentioned on the last sheet banking system, HSBC and other banks, but they invest in ethical industries. They invest in American Imperial Tobacco and other tobacco producers. They invest in Unilever, they invest in Nestle, they invest in Pepsi-Cola, in Coca-Cola. So why should we invest in the banking system, which is also very much interlinked with the industries in which we would not like to invest for ethical reasons? And therefore it comes to my conclusion, in fact, which is, do we wish to disturb these companies while withdrawing suddenly at once, or do we wish to accompany them in changing their business model? And it is not an easy answer, because we will not change the world in even 10 years or 20 years. Because I think in a way it would be too easy to say suddenly to a company, no, I do not want to invest in you anymore, while many companies, including the fuel oil industry, has contributed for so many years to our welfare. And in that sense, it would be unjust, unwise, illogical to say at some point in time, no, forever. So we should accompany them to change, but probably not to withdraw at once. Okay.
Thank you very much for that really interesting question. I'm going to actually pass this to David Palmer, the Chief Executive of the CFB, who can perhaps explain a little bit more about how those ethical decisions are made and why we follow those, why we follow the ethical approach that we do. David.
Sorry, I couldn't unmute there. Thank you, Francois, for that question.
Yes.
As an ethical investor, I think you need to have a very thick skin, because you'll never get an answer that makes everyone happy. Our job is to return money to our investors and bring about the best ethical results that we can. We take advice from Jackie, the Joint Advisory Committee on Ethics of Investment, and they guide us on issues that for Jackie and for the church are issues that are so fundamental to us, we should avoid investment in them. And pornography and gambling are two of those that clearly I think everyone would agree we should be avoided. You're right about obesity. That's an issue that Jackie has looked at. And we do engage with companies, ask them to look at how they promote sweets at shop counters, how much calories they put in their bars, for example. That's an issue that we feel we engage in rather than disinvest from. What brings about the best results? I've always said to investors that when we disinvest from a company on ethical grounds, I feel that means that we have failed. It means we've given up on our engagement. And to me, that's something that's a last resort. unless it's a sin stock that we need to avoid completely. So we rely upon Jackie to guide us on these very difficult, very complex issues. And they've done a terrific job over 20 years now doing that for us. We have to be thick-skinned. We'll never get the answers right. We just do the best that we can. But fortunately, through the church, we have deep thinkers in these issues, and they guide us in our investment policies.
Okay, thank you.
Thank you. David Haslam's question now. David says he's pleased that the CFB has achieved the fair tax mark itself, and wants to know which other companies you may have been in discussion with about that. So perhaps Christoph first, or perhaps Matt or Christoph could answer that question.
I'm happy to touch briefly.
Yeah,
so it's Epworth Investment Management that has achieved the fair tax mark, which we're obviously pleased about, and we felt that was an important step to being able to engage with companies by walking the walk as well as talking the talk. In terms of companies that we've written to, I'm not going to give names at this point, if that's okay. They are companies we are shareholders in, we have a good relationship with, but sometimes we like to engage privately, at least to start with, and we hope at a future date to be able to go public with other companies in our portfolio that have achieved the fair tax mark. But yes, I think at this point, I hope that's satisfactory, if not the preferred answer.
Can you give a sense of how many companies we've engaged with on this issue, Matt?
So we've started with, so having talked to Gleeson, we've written to a further 10 companies in our UK portfolios. At the moment, the fair tax mark is just a UK mark. There are plans to launch an international version, which might in future allow us to take our engagement to overseas companies. But we're very much at the moment looking to build a sort of groundswell of best practice UK companies with which we then have a more persuasive argument to take to some of the larger companies that we might have more questions about their tax practices. So this is very much a long-term project that we're just embarking on with the fair tax mark, we think.
David, I see you've unmuted yourself. Do you want to come back on that?
I was astonished at how shy the board is, and indeed Epworth, about saying what you're doing. I mean, it is a lot of good stuff, but if you tell us which companies you're approaching on tax, it may be that others of us have got investments there or other funds of one kind or another that we've got access to, that we could support that process, as it were, and complemented. So I would always say, I think the CFB has often been too shy to share in the public domain what we're doing, because by and large it's a good job, but it's too hidden from the members of the... I spoke with a group of local preachers on a Zoom meeting last night about the ethics of investment, and they hadn't really heard of Jackie, they hadn't really heard of anything that the CFB and Epworth might be doing in this. Basically, we're engaged in these very important issues, the mission issues, or in the forefront of.
Yeah, that came directly from the council in terms of our strategic thinking and our strategy day, and it's very much on our minds at the moment. So I've got another question in the chat room, and we'll make this the last. From Angela, is it possible to engage with a company and see a better behaviour in one country, but what about the same company behaviour in other countries? Matt, do you want to take this one? Or Christoph is unmuted himself, so Christoph, do you want to take this one?
Oh, that's a very, very good question, is what I would say. Yes, sometimes it does happen. Companies are made up of individuals and individual regions. sometimes we'll engage, especially if it's a company headquartered in the Western world, or the Northern world, as we often say these days. We'll engage with the company headquarters and the board in London, and they will tell us one thing. And sometimes that thing doesn't always happen on the ground in a very different environment in the developing world. And then we'll engage again, because we'll say, well, you said us that, you told us this, and it doesn't seem to always be happening. And in that case, often some of our customers and our member bodies have roots in other parts of the world and know much more of what's going on than we do. And that information side of life is very useful for those discussions. Sorry, that was a very brief answer.
Okay, thank you very much. We did say that we were going to make sure that we finished well before 12. It's now 2 minutes to 12, so I'm not sure whether that counts as well before 12, but I would just like to say on behalf of the CFB, thank you very much for your attendance this morning. Thank you very much for your interest. Thank you very much for your questions, which have been really helpful, and we look forward to seeing you next week at the slightly later time of 11:15 for our presentation then. So I'm going to call a halt to the meeting, and thank you again for all your attendance. It's been really helpful. Thank you.
Thank you very much.